Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Shares of MDA Space are getting a boost after profit in its first quarter topped estimates. Revenue also surged 32% compared to the year before, surpassing expectations. MDA's backlog also increased during the quarter, driven by demand in its satellite and space infrastructure unit. CEO Mike Greenlee says the company still has a $40 billion pipeline of potential business to tap into going forward. Shares of Linamar are trading higher after the company reported profit in its most recent quarter that topped estimates. Revenue also rose 16% to nearly $3 billion, surpassing expectations as well. Linamar says new U.S. tariffs will have more impact on its industrial segment, but won't affect its overall business outlook to grow sales and earnings this year. Well, the federal government projected a nearly $67 billion deficit for 25-26 in its latest economic update, almost $12 billion lower than the previous estimate due to a windfall in revenues. The update outlined several measures, including spending billions on training and hiring skilled trade workers, also raising Canada's standard of living. Still, there are some concerns. The deficit room is being used to spend more. BNN Bloomberg's Amanda Lang spoke with the Finance Minister, François-Philippe Champagne, and he says given the fog of uncertainty, the move is to help Canadians in a time of need.
The concern of people is affordability. I think we have demonstrated we are a good fiscal manager. We have restored fiscal discipline, but at the same time, you have to be where people are. I mean, if we were to go on the street, the concern of people is affordable homes, it's grocery, and it's gas. So we've used, we had $7 billion of additional revenues. We used about 2/3 of that to help people now. We struck the right balance between using some of these revenues to help people, but also to reduce the deficit.
Tune in to Taking Stock with Amanda Lang tomorrow at 3 p.m. Eastern to see the full interview. And taking a look at the markets right now, the TSX is now back down in the red. It's been a bit of an up and down kind of day, off by 0.37, and it's mostly being dragged down by the energy index, off by about almost 2% roughly right now. South of the border, you can see all red there as well. Quite a turn it just took. We'll have to see that over the lunch hour and chop down. S&P 500 out by about 0.3, and the Nasdaq's about a wash right now, off ever so slightly. All right, we are looking at earnings with reports out from companies like Nutrien, Linamar, and Canadian Natural Resources. Here to discuss that and more is Sam Lavelle, Portfolio Manager at Veritas Asset Management. And Sam, thanks very much for joining us.
Thanks for having me.
Overall, for the earnings season right now, how is it looking to you?
Well, we are through the bulk of it, and more or less most companies have gotten through. We really only have a month of effects from the Gulf situation. And some companies are citing that as a bit of a pressure. But overall, the discussion has been that the consumer's been quite resilient. And ultimately, people are still looking to the back half of the year to wonder how this is going to play through for a lot of the companies.
And I imagine the challenges the war is bringing to different industries, different sectors. Which is the one struggling the most with this?
I would say that ultimately manufacturing is potentially at risk here, because obviously there's trade issues still in the wind, and you have input cost inflation, you have some energy costs, and then ultimately you need to pass those on to a consumer now whose pocketbook is a little bit more stretched. Yesterday we had some earnings out of Whirlpool. They signaled a lot more weakness in their business, and that's a big durable item that people are kind of slowing their purchases of. But when we looked at the March retail sales, they were very strong in the U.S. Consumers seem to just bypass that a little bit. The only categories that really showed weakness in the U.S. were grocery and what they call food and drinking establishments, was bars and restaurants. Those were up, retail sales up just a little bit under inflation. So people are trimming back in the lower kind of end of the spectrum, where it definitely eats into your income. But overall, consumer remains resilient in the U.S., and we're seeing that in the earnings.
All right. One thing that we might see some pressure, I'm guessing, food possibly, costs going up with fertilizer, feeling an impact from Iran. Let's talk about Nutrien and their earnings report.
Yeah, so you see the price reaction to Nutrien pretty dramatic today. People are trading Nutrien like it's an oil name because peace in the Middle East would mean that the shipments would start flowing again. But the way that we think about this particular problem is that, unlike oil, if you interrupt the demand side of oil, you lose that consumption forever. Effectively, just people won't pick it up in the future. But if you delay applying fertilizers to your crops, you have to apply them in greater quantities in future years, otherwise your crop yields start to fall. So it's something that you can put off for a little while, but not forever. So we think some of the effects here for Nutrien are actually going to last into next year, quite a longer time horizon for fertilizers. And of course, a lot of that fertilizer shipment going through the Strait of Hormuz interrupted right now. The reason that Nutrien's down more or less is that they did have very strong revenues, but their EBITDA came in just a little bit above consensus, which meant lower margins. But if you drill down, that was really signaled by a shift of mix into retail, which just has a little bit lower margins, and away from the nitrogen segment. And when you drill down at the nitrogen segment, you find that it's really because the ammonia plants ran at only 92% of capacity versus 98% that people were expecting from last year, as they invested in some turnaround activity to improve operations. So they missed out on very high prices in the ammonia market because their volumes are a little bit lower than last year. So we actually think that gives you an opportunity in the back half to produce more because your plant turnarounds have been completed. And we're still very constructive on the fertilizer market. So I actually see this as a buying opportunity for Nutrien.
All right. Linamar, good solid report out.
Yeah, Linamar, I mean, just quietly, Linamar's been, through acquisitions, acquiring a lot of advanced manufacturing capacity. Two of their most recent acquisitions, GF Leipzig and Aludyne, they contributed to the first quarter. They had $758 million of new business wins in the first quarter, which is a record for the company. So it's really a growth company through these really smart acquisitions, trading at a very discounted multiple, 8 times earnings, 4 times EV/EBITDA. There are some challenges here with tariffs. They are largely protected. About 90% of their sales are under USMCA. We do understand that a USMCA will be under renegotiation for the next however many years. But that protects them from a lot of the tariff activity. Two of their segments, two of their business lines that do have some effects because there were some changes to the tariffs which effectively took it out from content. Metal content was being taxed before, and now they're putting in our product categories, and they tax the entire product category. So slightly increased tariffs on certain types of products. The company indicates that for agricultural equipment, for example, and their Skyjack production, which falls in their industrial segment, there are some effects there. But overall, maintained their guidance for the year and moved up to high single-digit growth and continued earnings growth. So again, very good, well-managed company. You're getting it at a discount. Very good quarter. This quarter.
Yeah, their Skyjack volumes up 66% because of the data center construction. Amazing. I want to get in before we run out of time. CNQ. So
CNQ has, started at the end of January as a $50 stock, now a $60 stock, and people are trading it with the oil price. What we look at for the oil market is the December 2026 contract. That signals what the market may look like if this whole situation in Iran resolves. And that's still trading in the mid-70s. So in the mid-70s, CNQ will generate somewhere between $6.50 and $8 of free cash flow. So you're getting an 11 to 13% free cash flow yield on that $60 price, plus 4% plus volume growth. So we think that's a very good risk-reward trade-off. A couple of things to mention on CNQ is that they do have a bit more gas weighting. Gas is firming up, but maybe not as much as oil has firmed up. And they're not integrated. So they do have some exposure to heavy oil differentials in North America, but we see those holding up pretty well. So we like the risk reward on this one, still buyers of that one.
Okay, we'll have to wrap it up there, Sam, but thanks as always for joining us.
Thanks for having me.
Sam Labelle is Portfolio Manager at Veritas Asset Management. Up next, shares of Hammond Power Solutions continue to rise after the company reported increased profitability in sales in its first quarter. We'll get you a conversation with the CEO after the break. Hammond Power Solutions reported increased sales and profitability in the first quarter of its fiscal year. The manufacturing and power quality equipment company saw growing demand across its core U.S. and Mexican markets. We were joined earlier by Adrian Thomas, the CEO of Hammond Power Solutions, to discuss the earnings results.
The strong first quarter really came from electrification tailwinds as a whole. We operate in diverse sectors, but certainly we see increasing revenues coming from our data center business.
And is a reason? I mean, it's, for the most part, I would say there's reason for optimism, but from your side, seeing more of the numbers, do you see that being sustained?
Yeah, what we saw, and what's really amazing with the record sales we posted this quarter was that we continue to see backlog growth. And so high quotation activity plus backlog growth as we're shipping more than ever really shows to the durability of the demand for electrical equipment.
I think your backlog's at 122% at the end of 2025. Any concerns that's too much, or can you handle it?
We've been building out capacity. We just finished a new factory in Mexico. That's starting to ramp up. That was helped in part driving some of our profitability gains. The 90-point margin increase came in part from price realization, but also the ramp up and the better absorption of that factory. So we have been building out capacity, and we'll continue to look at doing so. And
where do you see the next build-out coming from for capacity?
So I think when we look at that, there's a lot of different factors that going into the where. I think the question is not if, but where and how much. And at the top of that strategic thought process is how we can best serve our customers. So we like to be close to our customers. So we'll look at how we can best serve them and what location, and we'll go from there.
And are data centers your sole source, or are you looking at growth elsewhere?
No, one of the important things through this growth has been for us to continue our focus across the broad spectrum of the sectors we serve. So we're serving a lot of electro-intensive industries, so things like mining, oil and gas, the renewable sector. All those continue to have good demand. Obviously, the data center demand has been growing quite fast, particularly in the U.S., but we see also things like healthcare and other large infrastructure projects driving additional revenue for us.
And what are some of the opportunities there with healthcare and those large infrastructure projects?
Yeah, so I think those are driven by investments as what are connected to sort of economic growth and population growth. And what we do is we provide critical infrastructure into those facilities. So both with our transformer, and we also announced an acquisition of a company called AEG Power Solutions, which should be closing this quarter. They also provide power quality and uninterruptible power supplies to ensure electricity is flowing reliably to those mission critical applications. So those are all the sort of opportunities that we have as the world continues to electrify.
And what kind of savings do you think you'll see with AEG?
So the AEG acquisition is more strategic versus a kind of synergistic on the cost side. They complement us quite well, both geographically. The main focus for us was portfolio diversification. Our sales in North America are predominantly dry type transformers. AEG will bring us a lot of power quality and power electronics technology. Their revenues are primarily stemming from Europe today, and we think there's opportunity for us to learn from each other on the nuances of our geographies. And finally, they bring a lot of services and aftermarket, so that provides some earning stability through economic cycles.
Could you see yourself going to Europe with this, from your side, going over?
Look, I think there's opportunities on both sides. In the beginning, we'll be very deliberate in terms of integration. So the leadership team there has done a great job to develop that. So we'll first and foremost ensure that they continue on that business development trend. But there are opportunities, I would say more so, for looking how we can leverage AEG products into the North American market space.
And do we see any more M&As in the future?
I think AEG is sort of step one in building out a integrated electrical solutions division or platform, as you might say, gives us critical mass. And so, acquisitions will continue to be part of our capital deployment going forward.
All right, and a possible headwind, CUSMA's coming up. What are your biggest concern? Is it tariffs? Is the fact CUSMA maybe doesn't get re-signed? How are you treating it right now?
Yeah, I think we can't control the trade environment. What you did see, the products, our transformers are CUSMA compliant, although we saw last year inclusion in the 232 tariffs. So we can't control what happens there. What we can control is how we respond. So we will focus on pricing, sourcing, operational execution. The best thing that can come out of that is businesses, we like consistency and stability. So we'll adapt how we need to adapt, and having a stable trade platform would certainly help. But we'll respond as we need to.
All right, and you've run up some debt. You're up to $18 million from $15 million at the end of fourth quarter last year. What were some of the factors, and how do you see yourself dealing with this?
Yeah, so a lot of that, we've been building out capacity. So we've spent around $90 million over the last 4 years to continue to increase our ability to produce with the new facilities ramping up, and with higher revenues, will improve our cash flows. The acquisition will put us into some term and revolver debt, but we believe we can deleverage that fairly quickly.
And any concerns with labor costs going up, with skilled labor, inflation pressures on income and things like that?
So I think the biggest thing on labor is availability of labor and skilled labor. So in our business, labor is a relatively small part of the overall cost, but having highly qualified skilled labor and retaining them is important. So we focus a lot on that. We are all our sites are recognized as a great place to work. And so I think creating the environment where employees want to stay is the most important thing we can do to make sure that we've got a good team delivering.
All right, one last kind. I'm going to let you toot your own horn for a second. Stock's up 240% this past year, 450% since you took over. What are some of the key things there for that?
Look, I think we're encouraged by the investor confidence, but I can't control the stock price. What we're doing, I think what investors are seeing is that we're in industries where there's some very significant tailwinds that are long duration tailwinds. I think electrification is not going away. And so we're just focused on servicing our customers. The faster we can convert backlog, faster they get their products, managing our costs to remain competitive, and investing in our future. So that's what we can control, and that's what we're focused on.
That was Adrian Thomas, CEO of Hammond Power Solutions. Up next, BCE beat earnings estimates as its big bet on AI starts to pay off. We'll have more after the break. BCE posted higher than expected first quarter earnings driven by rapid growth in its AI-powered business. The company's revenue rose. Shares are pretty much flat. The company says new AI investments, though, are setting it apart in a tough telecom market. Earlier, we spoke with John Butler, senior analyst for telecoms at Bloomberg Intelligence.
I think Bell is doing the right thing. They're really looking to tap higher growth adjacencies as that core wireless and wireline business slows. But having said that, they're still reliant on the latter two for growth. And I think the execution there was good, particularly given this slower backdrop.
So, and the higher growth adjacencies being AI, things like that?
Yes, so you alluded to it. They are building these AI data centers, the most recent one under construction in Saskatchewan, and they're very excited about it, I think, for good reason. There's a lot of growth to be had there, and I think it pairs beautifully with that fiber network that Bell has, because you need to interconnect the data centers to each other and to end users. So it's a natural adjacency for them. That project is well underway, and they are pushing hard on expanding that business to business, the B2B business, where they've always had a stake, but they're growing it now, and they're directing a lot of their capital over to these higher growth adjacent markets like the B2B business.
Just going back to the data center, I mean, there a lot of pressure on the CapEx and free cash flow. Any concerns about that?
Not really. Again, I think they're siphoning off, if that's the right word, or reducing their investment in the more mature, slower growth areas like wireless, the legacy wireline business. They view the Canadian fiber business as one that's too heavily regulated to merit investment. So I think you're seeing a redirection of spending, in addition to growth there, to be fair, but more a redirection from those slower growth legacy areas like wireless and the Canadian fiber market.
So that 113% growth in AI-powered solutions and Bell Business Market's 9.7% revenue growth trajectory, are those attainable, and can they continue with them?
I mean, that's the area to watch. You know, they're growing off a small base, so the numbers are going to look very big. But again, at run rate, you know, you're looking at 20 to 30% growth in revenue in the data center segment versus very low single digit in wireless. In fact, wireless this past quarter was really competitive. You know, if you look at pricing there, it was clear the gloves were off, and you know, it was a real battle for subscribers using price as the main weapon. So I think BCE is making all the right moves here, but it's a transition that's going to take time. You know, they're guiding to completing their build out goal of 73 megawatts, which is how they measure data center capacity, by 2028. So it really is a 3-year glide path here, and nothing that's going to happen overnight. All
right. And with wireless, is that almost a race to the bottom right now between all the companies, between all the telcos? Because we're stagnating. There's stagnated growth. There's only so many people around. Who do they reach now?
Yeah, I mean, it's you just hit on it. It's a saturated market. Having said that, I was really impressed with how Bell executed during the quarter. They took a step back and said, we're not going to compete hard on price. We'd rather attract premium subscribers to the Bell brand. And, you know, they had decent net additions, which is how you measure the heartbeat of wireless. They had about 17,000 contract net additions or loadings during the quarter. Which really impressed me. What happened, of course, is pricing took a hit. It was down a little less than 1%. And that really can affect your revenue growth in the quarter. So service revenue fell modestly during the quarter, less than 1%, 0.6%. And that's what impressed me. You know, they really didn't participate in that race to the bottom, as you described it.
And that was John Butler, senior analyst for telecoms at Bloomberg Intelligence. And of course, BCE is our parent company. Well, shares of Datadog are surging after the company raised its full-year outlook and delivered growth fueled by AI demand. We'll break it all down after the break. Shares of Canadian Natural Resources are slipping. The energy producer missed expectations for average production in its latest quarter and also reported output for crude oil and natural gas liquids that fell short of estimates. The company's bitumen production also fell 3.5%, missing consensus. One bright spot in the quarter, however, was that revenue and profit beat expectations. Shares of Sherrod International are plunging. The Canadian mining company is suspending participation in its joint venture in Cuba. The move follows expanded U.S. sanctions, and though the company has not been formally designated under the executive order, it notes a designation could occur at any time. Sherrod is bringing employees back from the island and says there is no immediate impact on its Canadian operations. Air Canada is cutting 4 seasonal U.S. routes earlier than planned. The Airline says the decision was made due to rising fuel prices, and there are plans to resume the routes in the summer of next year. The move will affect flights to Sacramento, Raleigh, Charleston, and Austin. Air Canada says affected customers will receive alternate travel options, including full refunds. A bit of an up and down day, now getting very much into the down. You can see the TSX off by about 0.7% after seeing some green all morning. South of the border, it's a similar situation. Started out promising and has quickly taken a turn. S&P 500 off by 0.44. NASDAQ down by a quarter point. Datadog is soaring today after posting first quarter profit and revenue above estimates and significantly raising its guidance. Joining us to help understand this surge is Fatima Boulani, Managing Director and Co-Head of U.S. Software Equity Research at Citi. Fatima, thank you very much for joining us.
Thank you for having me.
What's the good in here? What do you like about these numbers?
Well, Datadog brought the goods and then some. The expectations on this stock were relatively high heading into results this morning. This was a stock that was down 3% year to date. But in the broader context of enterprise software, that was a massive relative outperformance. And so the bar was really high and the company delivered. We saw accelerating revenue growth sequentially from 4Q into 1Q. That's only really happened once before, and it didn't even happen during COVID. And so really the momentum that has built here really substantiates our view that Datadog is a consequential company and an absolute winner in the AI circle.
And what about on the downside? Any numbers of concern in there?
It was a beat and raise, so a very classically strong print. But what gets us more excited is management's commentary around how they're thinking about guidance. Now, look, there are absolutely customers in Datadog's install base that are very large, but the company has been very explicit about managing their guidance or risk adjusting their guidance with respect to some of these larger customers and some of their usage patterns, which we believe are very sufficiently de-risked in the guidance. So the punchline here is not much to shake a fist at. And the scope of the guidance increase, we think there's actually still more estimate revision upside left, which means we think the stock can move higher from here as the company continues to show what we think is a pretty rarefied combination of accelerating growth at a 30% cadence with expanding margins. And that's a combination that is, frankly, pretty rare in software right now. And this company, as I mentioned earlier, is very directly in the crosshairs of all of the AI adoption and the torrid growth we're seeing out of some of the most valuable private companies in AI. This company is absolutely in the right path, in the right place to capitalize on the continued growth here of adoption.
And any concerns with SaaS here? I think it was up 21%. Is that the number I saw? Is that sustainable with SaaS, with everything that we've seen over the last little while?
Yeah, so what I would tell you is in the realm of enterprise software, there is the SaaS apocalypse fears, but those are largely pertinent to some of the application software names. What Datadog fundamentally does is on the infrastructure software side, and really the tooling and the capabilities and the platform they offer is functionally the equivalent of a MRI machine for your entire IT system and IT organization. And so this MRI machine is, which is the Datadog platform, is on 24/7. It tells you exactly where there are problems in your applications, in your infrastructure. And with AI coming online for all organizations and all enterprises of size and scale, that infrastructure complexity, that IT complexity and sophistication is only moving higher. And when that vector rises, that is Datadog's friends, because they help spot the needles in the haystack as it relates to problems in your environment, because if you don't find those problems very quickly, that creates a very costly operational downtime and even revenue losses. And as organizations sort of march towards bringing more and more AI into their systems and becoming more AI enabled, that's only going to raise the bar for observing where things can possibly go wrong. And Datadog is the absolute answer to that, which is why we think they're so perfectly positioned as these trends continue.
Is it getting into moat territory, would you say?
It's a substantially wide moat here. One of the anecdotes I'll share is some of the world's largest companies, so the hyperscalers, the public cloud providers, the AI native companies, so the Anthropics and the OpenAIs of the world. You can imagine these companies are infinitely resourced from a technical headcount perspective, clearly from a financial perspective, but they are voting with their wallet on aligning with Datadog as their vendor of choice to make sure that their lights are always on and they're shipping products quickly because Datadog is the platform that is enabling them to do that without any downtime and outages. So that moat, we think, is widening, and I think it's very important to call out the fact that the world's largest companies believe that a third-party vendor like Datadog can provide such a tremendous amount of value in enabling their business.
And do you see any potential headwinds for it right now?
This is a classic case of high expectations, and the bar is going to continue to rise and move higher here. Some considerations around, is there potential for customer concentration risk with some of these very large vendors? By our calculations, OpenAI, which is a customer, is spending upwards of $300-400 million with this company. So that's no small potatoes from the standpoint of having one customer spend that much. So, outside of those sort of dynamics, we don't really see any hurdles or impediments for this company to continue their momentum, because again, they are very levered to the exact trends that are unfolding that we think are going to be trends that are going to be enduring for the next couple of years.
Okay, we have to wrap it up there, Fatima, but thank you very much for joining us.
Thank you.
Fatima Boulani is Managing Director and Co-Head of U.S. Software Equity Research at Citi. Coming up, Kinaxis reported a beat in revenue for its first quarter. We'll speak to its CEO on what's driving that beat and more. Stay with us. We are watching shares of Kinaxis today after it reported a beat in revenue for its first quarter and demand for its Maestro agents. Here to discuss its latest report and more is Razat Gaurav, the CEO of Kinaxis. Razat, thank you very much for joining us.
Great. Thank you for having me.
A good first quarter there, 25% revenue growth. What was driving that, and what makes you think you can sustain it?
Look, as you know, we've been in the supply chain planning and orchestration space for some time, and we just built an amazing platform. And I think the big growth drivers really come down to three things. One, just the overarching increase in supply and demand volatility, given all the macroeconomic issues, the geopolitical issues, the tariffs. That creates a bigger need for our platform, for our customers. Second, I think, there's a lot of shifts happening on the technology side for our customers, and they're really looking to deploy modern solutions that can take them into the agentic age. And we at Kinaxis, we've been investing in our platform, and we've got the world's best supply chain planning and orchestration platform that has a ton of AI capabilities and agentic capabilities. And that's making us win more business. And the third reason is I think just our team is executing a lot better, right? Executing both from a go-to-market perspective, as well as ensuring that we can deliver, value to our customers as well.
Now, you mentioned about shifts for customers. What are some of the shifts, and how are you keeping up with it?
Yeah, look, the shifts are very specific to different industries. We play in 7 verticals, but I'll give you some examples, right? So, in the whole high-tech value chain, for example, there's a big surge in the buildup of data centers, given the AI economy that's emerging. And that's impacting, a lot of companies that are not just the hyperscalers that operate these data centers, but also all the suppliers in that value chain. So the storage and device providers, the semiconductor chip companies, the energy utility companies, the cooling unit providers, right? And so it's creating a massive surge in demand while they're stuck with, fairly constrained supply. In other industries like aerospace and defense, again, we're seeing a surge in demand given what's happening in the world, but they are, constrained with supply and with very complicated bill of materials, and they need capabilities that really help them optimize to service that increase in demand. In other industries, like in CPG, for example, there's inflationary cost pressure happening with the surge in the fuel prices. Obviously, many companies got impacted with the conflict in the Middle East and with the blockade with the Strait of Hormuz. So they had to look for really rethinking and reimagining their product flows. So there's just a lot of disruptions that are happening in the supply chain world, and all of that creates the need for an agile solution that allows them to balance demand with supply, quickly run scenarios, do replanning capabilities in a smart, intelligent way, leveraging data and algorithms. And that's what we do at Kinaxis.
And is this where the Maestro agent is coming in, and the new tailored agent composability? Can you explain a little bit what that is?
Yeah, so what we've been working on, and we announced this last quarter, we've been getting great early adoption with our agentic infrastructure as well, where we've ingested within Maestro, our core Maestro platform, an agent studio, and we've also released several packaged agents. And these agents are really designed to drive productivity improvements, to really drive, automation in the workflows for our customers in their end-to-end supply chain planning and decision-making processes. We've also attached to Maestro now an agent studio that allows the composability. So now you don't have to just be constrained by what you get out of the box from us. You as a customer or our partner ecosystem can also compose agents based on different use cases, and they have access to all the data and resources from across all of Maestro to be able to compose those agents for driving automations, driving intelligence, driving predictions, and also driving all kinds of productivity improvements.
Okay, I want to jump in about SaaS was up, revenue was up 21%. Do you see that as sustainable with everything that's kind of unfolded with SaaS lately?
Well, we've given our guidance, and we've been very comfortable with our guidance. We gave a guidance of 17 to 19%, and we reinforced that guidance on our earnings call this morning. We're very confident that we'll either meet or beat that guidance. But look, I think we have a lot of good momentum. Q1 was a great start to the year. We're seeing a lot of pipeline and a lot of activity in our customer base. So my goal clearly is to continue accelerating the top line growth while maintaining a very responsible and a profitable business model.
But any concerns about SaaS with what's unfolded over the last little while?
Not really. There's a clear dissonance between what we hear in the media and in the financial markets versus what we are seeing with our customers. Our customers, in fact, are doubling down with us. We're a SaaS company, but not every SaaS company is the same. We solve very complex problems that are rooted in deeply advanced mathematical models, leveraging machine learning, leveraging optimization capabilities. And we are leaning in and leveraging both generative and agentic AI in our core platform. So our customers are looking to do more with us. They're not looking to do less with us. And, with the line of sight we have, we see us continue to grow and thrive and create more value for our customers using all the latest and the state of the art in terms of technologies.
So this was your first quarter, right? I believe, as the CEO. Right. What do you do? Right. What do you do for an encore?
What do I do for an onboard?
What do you do for an encore? I mean, this is your first quarter. It's a good first quarter.
Well, I've every intention to continuing delivering every quarter. I mean, this is a long-term journey, as you know, and it's all about long-term growth as we realize our vision for becoming the supply chain decisioning and orchestration platform. But of course, we're going to keep delivering one quarter at a time, and that's my goal here.
All right, Razat, we have to go there, but thank you very much for joining us.
Thank you so much.
Razat Gaurav is the CEO of Kinaxis. Still ahead, today's market movers with Bloomberg's Matthew Griffin. Joining us now for some movers south of the border is Bloomberg Equities reporter Matthew Griffin. Matthew, thanks as always for joining us, sir.
Roger, thanks as always for having me.
Boy, oh boy, Whirlpool, I'm just looking at some of the quotes from the company about how that last quarter went. It is a rough one for them.
I know. Well, Roger, I was planning to do something I don't often do and just read from the washer and dryer makers' earnings release. They say that, quote, war in Iran resulted in recession-level industry decline in the U.S. They say that consumer confidence collapsed in late February and March as a result of the war. You know, these are big-ticket items, a washer, a dryer. They're expensive appliances. It's the kind of things that consumers are wary to buy when they don't know if they'll be able to afford it, if they're going to look back and regret that purchase. So if you look at where that showed up, this company slashed their profit outlook for the full year by more than half. They now see adjusted earnings per share of around $3.25 US. That's down from $7 previously. Their sales missed in the most recent quarter. Their results unexpectedly swung to a loss on the bottom line. And you know, you look at the U.S. stock market, we are still trading near all-time highs, and yet there are cracks under the hood, and they are starting to spread to consumer names. We've heard warnings just recently from Kraft Heinz, from McDonald's about the pressure consumers are facing. You've got higher gas prices. We were already in this low fire but low higher job environment, and I think everyone is waiting to see how much pressure continues to build.
And is Whirlpool adapting? Are they looking at this as short-term, or do they think this could take longer?
You know, what Whirlpool focused on was the steps that they're taking. No one really knows how long the conflict will last. One thing they also flagged is that prices are too low in the industry. You had the tariff rollbacks due to the Supreme Court decision here in the U.S., and they say they've implemented double-digit price increases. Citi analysts say that should be defensible. I think one question, though, is whether consumers are going to find it acceptable, whether they're going to want to pay for that.
All right, and maybe another sign of the times, too, Shake Shack sinks on a revenue miss.
Yes, so Shake Shack, record 30% drop earlier in the session. It's interesting, this is a consumer name, and yet the reasons here are a little bit different. Okay. You had severe weather in the winter hitting results. I mean, you and I both lived through the winter we just had here in the East Coast.
It hasn't left here yet.
Not fun to go out to eat there. Yes, well, it gotten a little better, but yeah, a little chilly today. And you also had high beef prices. They said beef prices were up double digits, but they didn't raise the prices of their hamburgers to account for that. And so they see some tailwinds on the horizon, the World Cup, for example, but you're right, they did have a revenue miss in the quarter, and investors don't seem to be buying that things are going to turn around.
And competition see similar results and blame the weather and things like that?
You know, Shake Shack has been by far, I think, the weakest. You look at, some of the other names have been better. I would zoom out and think about the broader consumer space. For example, you had Coca-Cola's shares reacted positively to their results. And we haven't seen maybe as many huge names in restaurants reporting, talking about the weather like this. Weather has been a consistent theme, though. I think Shake Shack has been the hardest hit, is what I would say, at least in stock reaction.
Let's sneak in Fortinet right now. We got a beat for them, and we got about 45 seconds.
Yeah, so Fortinet, this is a cybersecurity company. They reported what Jefferies called a blowout first quarter, adjusted earnings per share 82 cents US versus 62 cents that Wall Street was looking for. It's actually their hardware business that was especially strong. They sell things like servers designed to run firewall software. If you look back to August, this stock fell 22% in a day on concerns about the sales of their firewall software. Now we're talking 9 months to the day after that. Shares up double digits today, set to finally wipe out that decline.
All right, we've got to wrap it up there, but thank you as always, Matthew.
Roger, thanks for having me.
All right, Bloomberg's Matthew Griffin. And that wraps up this edition of Trading Day. Have yourself a great afternoon.